All right, we're live. You're watching Interchain Jam, a series on the Interchain FM, known as the Cosmos radio station. If you're seeking alpha and cosmos, look no further. I'm your host, Django Unchained. Before we get started, I would like to remind you that Interchain FM is a wholly self-funded program. We do all of the programming and post production for this show. It is a public good. So if you'd like to support us, you can go ahead and delegate to Interchain FM on the chains that we support. And if you would like to support us on our YouTube channel, you could join by becoming a member. And with that, I would like to thank Mike Purvis and Professor Pouncey for being our core supporters. If you like this particular show, please go ahead and like and subscribe to the channels that we air it on. Now let's get started. We're hosting Duality on this particular episode. Full disclosure, I am an investor in Duality, and standard disclaimers apply. Nothing we say on the show should be construed as financial advice. It's just pure alpha. And I have here Nicholas Evans, who's the co-founder of Duality. Thank you for coming on the show.
Hey, thanks for having me.
Well, tell me about your background and how you got into Cosmos.
Cool, let's do it. Quick disclaimer of my own. I am in the middle of a thunderstorm. I just had a huge, I don't know what to call it, but it was right outside. It was very loud and very scary. And I'm getting ready to join on my phone in case something happens to the Wi-Fi, because it did 10 minutes ago. So we'll see how it goes. But yeah, let's show must go on, like Django likes to say. So let's just right into it. My background is from Ethereum. I joined the crypto space at around 2016. I remember I went to a consensus conference in August around the DC area. I think the topic was around plasma or something, and I was really intrigued. So I started talking with the folks there, and they offered me a job really quickly, and that was kind of the beginning of it. So for about a year, I was at Consensus. I was doing some developer training, some they gave me a show actually, and for about a few months, I was doing the Nicholas show where we were going through. Well, it was my task to like review the code base of a bunch of cool products at the time. I remember Uport and some other really, all of some like big buzz projects at the time. And
Blast from the past.
Blast from the past. I know it feels like yesterday, but remember I would
For
read
you,
the Solidity code. Excuse me.
For you, feels like yesterday. Uport sounds like a relic of it's like an archaeological artifact at this point. For me, it's been so many years. What? ENS?
ENS isn't. It's around still.
Right.
But yeah, Uport. Yeah, it's definitely a relic from the past. I mean, we were all excited about it at the time. So I mean, yeah. So just going through code, seeing how it is, and then kind of going through it with whoever wanted to join the show. We would go like line by line. We would see if there's vulnerabilities, identify them moving forward, and that got me really interested in auditing and security. But after that, I joined Thesis. Worked on Random Beacon and TBTC, which is like the first decentralized Bitcoin to Ethereum bridge. Worked with a lot of really smart people around that time. It was a lot of fun. Got really deep into Bitcoin as well, like all the internal functionings of it for the purpose of working with SPV proofs and all that. Then about 2 years, two years and a little bit later, I joined Element. You see the lightning. It's hopefully it doesn't. Oh God, Anyway, joined Element as a founding engineer for a little over a year, and during the last few months of my time at Element, I synced up with Elijah, which is my other co-founder here, because he was also working on something tangential to the constant price AMM functions that we had been exploring at the time separately, but then together. Then we got really excited about it, and this was still all back in Ethereum. We were, we started working on it together. We had our we did a bunch of research and had our contracts ready for audit. And by then we had actually formed the company, and we were actually thinking a little bit more long term about what the vision of Duality actually looks like. What can we actually do in the stack we're at? We spend a few months actually just sitting back and brainstorming different ideas, different avenues that we can take based on research that already exists, and some new research. And then was a jump from Ethereum to Cosmos. It's like, why are we actually on Ethereum when we're sacrificing so much? We can't. We had this huge feature set and all these cool things we wanted to do, but we just couldn't do them on Ethereum, mainly because we didn't have full stack control. So we spent some time thinking about where we could go to get that full stack control, and Cosmos ended up winning. That's the short of it. And now we're here, and it's fantastic.
Yes, Cosmos seems to be the logical solution for anyone who is looking for that. So that's been my answer to anyone who says, well, why do I need Cosmos when I just have Ethereum? But at the same time, there's also tons of developers who would prefer to have the fully composed economy that Ethereum offers without, and while trading off that control. But yeah, that being said, Duality is proposing to launch as the second replicated security consumer chain of the Cosmos Hub, powered by Atom. Why don't you talk about that?
So hopefully it would be the third, but that is a good segue. So we can talk about a little bit about Interchain Security as a technology, and then we can also talk about the reasons we chose Interchain Security as our as a means to launch. So just very briefly, Interchain Security is a way for the Cosmos Hub validator set to kind of share that security with chains that are launching. So one of the big problems with new chains is that they struggle to find economic security and bootstrap a robust validator network. With replicated security, these chains have the opportunity to utilize a very robust decentralized validator network from the get-go, the same one that the Cosmos Hub actually shares. It's not dead simple by any means, because there are some incentives that are at play here for the Cosmos Hub validator set to be incentivized to take on the additional overhead of running an additional chain or an additional binary. There's some things that need to be taken into account. It's like, does this consumer chain sufficiently align with the Cosmos Hub? Will it produce enough rewards to make it worth it for the validators? Would it be worth it for the smaller validators? So there's like the incentive structure is fairly complicated there. It's just one of our initial concerns with launching on Interchain Security. On top of that, like, a lot of our concerns were eased because we believe that replicated security or Interchain Security is a phenomenal product. It's a very good idea, and it's probably one of the first things that the Cosmos Hub has done to actually reach product market fit. Because before replicated security, the Cosmos Hub was basically just a chain that mints Atom, that issues Atom, and Atom just is just a token that secures itself. At the end of the day, there's no real use case. Replicated security is a great use case, but it also comes with its own set of challenges. The main set of challenges is that any additional chain joining replicated security imposes an additional fixed cost per validator. Some of these smaller validators do not receive a very large portion of the rewards that consumer chains generate, and oftentimes the fixed cost is higher than their variable reward. That being said, there's a lot of solutions that are in the making. A lot of solutions that we've heard from different people in different avenues. One thing we're trying to do right now is unify everything, unify mindshare, and unify everyone that is affected by these issues, and bring in people that are responsible for building and maintaining ICS as a technology. Talk and think about solutions that we can do and we can actually have ready today. Talk about like medicine that can be administered to kind of alleviate some of the symptoms of the problem before we can actually, jump in and think about how to actually turn this technology into something more sustainable. And we have an open Telegram group that anyone is willing to join. It's an open group. Anybody can join, and we have a working doc. The goal of it is to serialize these solutions, create some urgency around them, create some prioritization around them, and then start pushing to get them answered as quickly as possible, because the decentralization of the Cosmos Hub and the replicated security product itself is all at stake. That being said, the reason we chose to launch on ICS is, or on replicated security, I'm not sure which term to use these days. But the reason we chose to launch on replicated security is because we believe it provides a lot of value to the chains that are launching on it. And the way we think about the incentive issue here is that we're not proposing a split. We're not proposing any kind of split. In fact, we're giving away all of our revenue from any sources fully back to the Cosmos Hub. So there's no kind of incentive alignment issue. We want to fully incentive align with the Cosmos Hub and make that work for everyone.
All right, so you've just explained one major issue of interchain security, and that's an economic problem. Just to summarize, the problem is that the validators that are currently validating for the Cosmos Hub are required to support every single consumer chain, which means that you're effectively running an additional node, and that comes with a fixed cost. So if it costs $2,500 now to provide consensus and security for the Cosmos Hub, double that cost for an additional chain, because your node is processing all that data, and the revenue that you generate is variable. It depends on how much stake you have on the Cosmos Hub, and it's not clear whether or not the fees or the gas fees generated on the consumer chain will be sufficient to even get the validators to net zero, right, with the additional cost of running another consumer chains node. So the question is, how do you not only make it net zero for a validator to run consumer chain, but also profitable so that the system can sustain itself? Right? Imagine if you extrapolate this to 100 other consumer chains, and those chains themselves don't actually generate any additional, they don't generate significant fees, because a lot of these chains actually bootstrap usage by offering zero fees at the very beginning. So validators are getting nothing for that. And on top of that, if Duality does not have a token at launch, or ever will have a token, how does the validator get see profit ever? Or do they, is it that they should expect negative EV from running replicated security for all these different chains? But at the same time, the open question is, given that now the Atom has this additional utility, a very valuable utility of being the de facto interchain security token, so that the Cosmos Hub ends up being, the NATO, so to speak, based on like the analogy Sunny likes to make, then ostensibly that makes the atom more valuable. So then there's also that open question of, if we keep growing the Cosmos ecosystem, then would it lend itself to giving the atom a monetary premium, and by how much? And is that value worth replicating security across like hundreds to thousands of chains with like a fixed cost? So that is a big question.
Yeah, so those are all really good questions. So yeah, you mentioned a future where there's 100 consumer chains. The issue currently is we need to find a way to create a path towards that, because right now, past like 6 to 7 consumer chains, we expect to see kind of resistance by validators if their concerns aren't alleviated, or at least met by some metric, which is again why we're really focusing on at least some short-term solutions that help. In terms of having Atom benefit from all of this 100%, this is kind of the goal, which is why this is so important. Atom could really be the center point of everything here, and it's extremely well positioned to do that. But it does need to be done with care. Duality on Interchain Security, no token, but Atom is the token. So we're kind of doubling down on that specifically, right? Without having a native token for Duality and leveraging Atom for everything, that kind of increases Atom's utility overall. And of course, there's like speculative aspects to this and everything, but all else being equal, if the value of a governance token is equal to the value of the protocol, then Atom should increase proportionally by the value of Duality in terms of its price. And a lot of what you said around having Atom benefit directly from replicated security, a lot of that comes from how aligned are these consumer chains with Atom? Are they actually leveraging Atom? Are they using Atom? Are they helping it? Are they actually providing enough value back to Atom? Or are they just siphoning value? Because if they're siphoning value and they're not actually providing value, then there's an argument to be made that Atom will be weaker. If they're actually providing value, then yes, Atom will definitely become stronger. At the end of the day, it really depends. And I mean, I see the argument from both ways. Even if there's a consumer chain that is siphoning value in some certain use cases, it could not be profitable itself, but it could provide really strong network effects with other consumer chains that can potentially bootstrap the Atom zone. But this feels like a little bit complicated territory. I think the best thing to do right now is to align with Atom as much as possible, try to help the validators as much as possible, and set some sort of precedent for collaboration and alignment with the hub moving forward for consumer chains, at least until we get to a point where some sort of economies of scale can take place and reduce the fixed cost per validator per consumer chain. I mean, until then, which actually that time could be soon, because we're actually seeing a good amount of engagement, and the doc that we have for working solutions to it has been populated decently to a point where within the next month or so, we're going to continue growing the network, and we're going to continue adding more people, more relevant parties, and adding some priorities to the list and start getting some of these things done. But until then, it's all about alignment and being selective with what consumer chains go online. But at the end of the day, this could be a huge factor in Atom actually becoming a very, very powerful player, even more powerful than it is today. Like, currently, it's probably the biggest elephant in the room, and actually being able to leverage that and use that in a way like this is really going to be incredible if done properly.
So the analogy that I would make about the atom and its relation to consumer chains adding or extracting value from the atom is that the atom could be analogous to the US dollar, where the Cosmos hub is these, Federal Reserve, so to speak, that is exporting US dollars to all of the different countries and nation states that have their own native currency. So if they are using the quote unquote world reserve currency, the atom, for their security and as a more sound money than their own native currency, then by definition they're adding value to the atom. It's the same thing, same dynamic with the US dollars, right? Right? Like if you're a new currency, or if you're a new country trying to start a new currency, like Liberia or whatever, and maybe Liberia has its own, is trying to bootstrap its own central banking currency, but it needs to peg itself to the U.S. dollar. Then by definition, by existing and needing to have a central currency that is pegged to the US dollar, it increases the value and lower bound of demand for the US dollar. So, with that said, the caveat is that it's not so. There's like a lower bound of cost for the validators to be able to export, or for the validators who belong to the multi-sig set of the Federal Reserve, let's say, to export the US dollar, because now, for the atom to secure um, those little nation states, you need to send troops, like you need to send military power physically to their countries to secure them. That's what's happening right now. So that's why there's this extra fixed cost. So I think I think framing around these very tangible terms helps it become more easily understandable for our listeners in that sense. But the question is how we could, like what the parameters around these are, right? Like, can we sufficiently cover the cost of exporting military power to all of these little sovereign countries, while having them peg their currency and economy around the atom?
Yeah, that's a really interesting way to frame it. I've never heard it as a never actually heard it framed like that before. But yeah, totally. That's a really nice way to put it. And at the end of the day, it's a balance of how much does this consumer chain generate in revenue, how much of it goes back to validators, how many validators remain profitable after the income generated by this, or the fees, or from any source, actually, application, network governance, whatever, revenue, how much of that revenue is making, how many of these validators are profitable after this revenue, how many are not, and is there any way to distribute it a little more cleanly in a way that protects the lower bounds? Because um, the nation state is actually made up of a bunch of individuals that run their own validators, and they have a smaller and smaller and smaller stake in in uh, in the network as their total staked amount gets lower. At the bottoms of the network are generating something like point oh some percent of revenue, and point oh some percent, even of something massive, can sometimes not cover the fixed cost, which is why there's some ideas of like universal basic income for these validators, where all the revenue generated by interchain secured chains is kind of collected, and there's some fixed cost generated by some sort of average that's fixed for the server costs or whatever, and after reaching that universal basic income number, that's distributed evenly across the validator set, and then the rest is distributed based on stake. That's one of the many ideas that's been floating around in our working group. There's mixed feelings about that. There's some complexity, and it is, again, it's just a medicine. It's not really targeting the root cause, although that's probably fine for now. On top of that, there's I mean, I can argue both ways for that. I mean, at the end of the day, it's up for community vote, and see what the community has to say about it. See, we can go into some more potential solutions, but I just really wanted to frame and really wanted to get into the importance of protecting the lower bound of validator sets, because at the end of the day, having a distributed and diverse set of validators is kind of what's providing value to replicated security in the first place. So we need to think about it in that sense.
The takeaway is that it's an open question, and there's a public experiment underway trying to figure out where the parameters lie. So, in the early days, while we are experimenting with the bounds, something clunky or rather manual, like doing a UBI, so to speak, using Atom as subsidy to pay each validator for replicating security on a consumer chain that is not yet profitable. That could work until, for like maybe 1 or 2 years, until the whole interchain economy has gotten its feet under it and figured out where the bounds are. And then until that happens, then it could be a more automated process. And then now we're not in this experimental territory, and then we have the answer. I think that just comes with the nature of the space. You're in alpha territory as always with such a nascent industry. So that's to be expected. And very much appreciate you guys carrying the torch on like leading this conversation about like where, trying to figure out the answers to that, right? So enough about that. Let's talk about Duality. So you guys are building is it an order book DEX, or is it a hybrid order book and AMM DEX that's its application specific chain using Atom for security?
That's right. It is a hybrid between a order book and an AMM. In fact, in many ways, it is an order book with additional functionality, because the insight here is that any AMM can be replicated on top of any order book. It's just an automated trading strategy on top of an order book.
But is the order book portion centralized?
Is it centralized?
Yeah.
What do you mean by that?
As in, is the order book portion not fully on chain?
Oh, everything's fully on chain.
Okay.
Yeah. And so oh, sorry.
Mm-hmm. All right, go ahead. No, go ahead.
Oh no, I was just going to jump in the underlying mechanics of it, but if there's additional questions, I'm happy to answer.
No, I just, anytime someone claims to have an fully on-chain order book, I think they're LARPing, but explain to me how you're not LARPing, or if you are, I'm going to figure it out.
You can, so our code base is, I mean, there's a bunch of order books like on Cosmos, right? How are they not fully on chain?
The order book aspect is mostly off chain from what I understand, what I've seen. I think DYDX is making an effort to make theirs fully on chain. But at the same time, I think it's still an open area of experimentation that the space hasn't fully solved. But go ahead, tell me how you solve that. Tell me how you do that and scale. To like what's going on? Is every single order going on chain as they're like every bid as they're made?
Yeah, everything is fully on chain. Everything is fully on chain. I'm happy to. Our code base is all open source as well. We have different benchmarks that we've run. So
how many orders are you able to make per block?
So
about like every 7 seconds.
We ran this like a few months ago, so I'd like to check back on the number. In fact,
okay. Well, you don't have to get me the number right now. That's just a like a intellectual curiosity. But can you go ahead and talk about the product at a high level?
Okay, so at a high level, Duality is an order book that allows for automated AMM strategies to be built on top of it. So we have a way for you to use the product as an on-chain order book by just placing specific limit orders. We actually don't have the UI for it. We only have the we have designs for the UI aspect of it, but our front end team's been busy with the AMM side of things. But on the CLI, for example, it can be used fully as an order book. It can also be used fully as a AMM. So the way this works is that if I have a specific order that I want to put in, say I want to provide liquidity to a certain pool. Say I'm providing it to the Atom USDC pool. The Atom USDC pool is just it's a very, very large order book. It's logarithmically spaced, and it has multiple discrete prices that you can provide liquidity to. So from there, you can provide at a specific tick, and this would be a constant sum pool. So the function is basically a constant sum trading function, where for a certain amount of input, regardless of how much is in each side, you're always going to get the same output, given that there's enough liquidity in that specific tick. And you can use it as a limit order where everything whenever a trade happens, it's immediately withdrawn, or you can use it as a constant sum AMM, where as you provide liquidity, it goes to the other side with some spread, which is the fee, which you determine the fee at the end of the day. You can have it at 0 fee and trade USDC and IST at $1. And when it's traded, the USDC for IST, the USDC goes to the IST pair, and then it's also tradable for $1 on both sides, in which case you're providing liquidity, but you're not making anything in fees, but you can do that. It can be 0. The fee actually that you're earning is the automation of the spread that you're providing the liquidity in. So you can actually compose that as arbitrarily as you want. So if you want to provide liquidity as a constant product on top of this pair, you would determine what the constant product function looks like. And in this case, if you want to replicate a constant product pool, all you would do is you would distribute liquidity uniformly across the entire range. That replicates a constant product pool. If you want to replicate a stable swap pool, you would do something similar, but it would be a bell curve, and it would look kind of like a bell curve around the current price, and then it would slowly dissipate across the edges. In fact, you can just remove the edges because no one needs dust on the edges of the AMM curve. If you want to use it as a Uniswap v3 concentrated liquidity position, you can do that as well. If you want ascending or descending or whatever you need, whatever kind of trading function you want to utilize, you can do that. The powerful part of this here is that this all happens under the same pool. We don't need to fragment liquidity to create constant product, constant sum, or Uniswap v3 pairs. That all happens under the same pair, which is the concept we call shared liquidity, where traders can now benefit from the aggregate of all liquidity of all these strategies. On top of that, we bring in some additional order types to give a little bit more freedom to individual users that are used to just the all or nothing type trading experience that currently exists on chain, where I have an input, I'm going to trade 1,000 of X for 1,000 of Y, and I want 2% slippage. If the slippage goes above 2%, my entire order fails. But here we can do it so, hey, I can trade as much as I want up until my slippage hits 2%, after which no more of my order goes through, but what has swapped at the price that I like still continues to go through. There's some additional order types that help with being a little more expressive as a user and as a market maker, of course, because at the end of the day, market makers have a really hard time on chain with the tools that exist, managing risk and inventory risk and block times and and sandwiching from MEV, etc. All that becomes painful, and building a product that is actually market makeable is quite important to us as well.
Okay, so if I'm using the order book and the pricing mechanism is denominated by a constant sum or constant sum curve, then what happens to the slippage if I make a large, like a sizable percentage of the pool bid?
There is no slippage. So just to help build a little bit more of a conceptual understanding, is that all strategies are built from constant sum, the aggregate of a bunch of constant sum pools. If you take any curve, any AMM curve that you want, you can approximate that curve with a series of tangent lines across that curve. The more tangent lines you have, the better approximated it is, and each one of those tangent lines is a constant sum pool. So I can approximate a Uniswap V2 position with, say, 5 to 30 tangent lines. The more tangent lines, the more near perfect my trading experience will be if I am a trader. Like, I will not realize much of a difference the more ticks that exist. And in fact, the difference that I do realize is often beneficial for me, because okay, so let's break it down a little bit. I have a constant sum pool that trades USDC for IST, like a Cosmos stablecoin. And these assets are one-to-one. It's one USDC for one IST. If I provide liquidity on a constant sum pool for USDC and IST, I'm trading them at one-to-one within that specific pair, within that specific tick. I'm trading them one-to-one, exactly one-to-one. And if there's no fee set by the user that provided that liquidity, I can trade, say the total liquidity in that tick is 1,000 USDC. I can buy 1,000 USDC with 1,000 IST with zero slippage. And on the other way around, now that the pool is full of USDC, I can buy 1,000 USDC with 1,000 IST. The other way around. If there's infinite liquidity in the current price and a constant sum tick, there will never be any slippage as long as the fee is set to zero. As a market maker, as a liquidity provider, I will not usually set my fees to zero unless I'm actually using it as a utility, unless I'm like one of the issuers of that coin and I don't care about making money off my position. I just want it to be a utility for the public to be able to trade, and I indirectly derive value from it, in which case, yeah, I could potentially set the fee to zero. But as a market maker, as an LP, I want to make some sort of spread on my fees, and this just provides me a way to automatically determine my spread. So if I provide liquidity at the current price of one-to-one for these stable coins, I can set a fee of 1%, in which case what that does is that it just changes the buy and sell price by a spread that will equal the 1% every time that liquidity is fully crossed over. So I'm just buying high and selling low in an automated way. That's just what Duality allows.
And how does this trade off capital efficiency, or does it not?
I mean, it does. So if it does not, and it does. So if users are, demanding really high fees, it's not capital efficient. If users are, racing to the bottom in terms of the fees that they are accruing, or there is a provider of liquidity that doesn't care about fees, then you can basically reach zero slippage, zero fee trades. So it really depends on where users are providing liquidity and how they're providing liquidity, and what the market conditions are, how volatile that liquidity is, because there could be a really good amount of liquidity in a certain price, but then there's a massive price movement, in which case now you can only trade by users that have like a 30% fee, in which case you just probably won't use that liquidity until there's some rebalancing that happens.
Okay, got it. So with Duality, your three sources of revenue would be from using the network, the liquidity provider fees, and governance. So all of this demand goes back to spending the atom. Is that how it works?
You cut off very briefly after all this demand.
Oh, so your three sources of revenue on that chain goes back to using the atom. So is it true that if I'm staked atom, then I get to vote my pro rata portion of my stake weighted voting power on Duality's governance proposals?
Yeah, that's correct. We're forwarding 100% of the governance power of Duality onto Atom. And as for transaction fees, MEV, etc., all that will be directly controlled by the Cosmos Hub. We can have our recommendations and preferences, but at the end of the day, that's all controlled by the Cosmos Hub, and we're just trying to align this product as much as possible with the Cosmos Hub.
So, given that, or in your proposal, or in your future proposal that you're going to make to the Cosmos Hub, your Duality is going to ask for 500,000 atom from the community pool to bootstrap liquidity at launch. Right? This was the precedent that Stride had set with their earlier proposal. So if you're using atom for liquidity injection, then are you planning to use the atom as the base pair of Duality, or else what are you planning to pair it against?
So yeah, of course, everything will be atom base paired here. And we actually had some confusion in our proposal around our plans for the liquidity injection. It's not like something that Duality will control by any means. This is something that the Cosmos Hub will control, and this is a means to bootstrap Duality to make it more profitable for validators quicker.
How would that how do you suggest that will happen?
I mean, quite simply is there's more liquidity on Duality. There's more users, there's more transaction fees. More transaction fees go to validators. That's the TLDR of it. Also, on top of that, this liquidity injection is it's still part of the community pool. It's not the community pool taking value away from the community pool. It's the community pool changing the composition of a small part of itself from Atom to an Atom X LP position that it can control. It can withdraw at any time, and but probably and hopefully earn a good number of rewards from over time, like in terms of opening up the ability for the Cosmos Hub to actually benefit from interchain activities, like Ethereum to Cosmos is quite a large market. Currently, the Cosmos Hub doesn't directly benefit from any of this volume, and that's an example of a market that the Cosmos Hub can directly benefit from by having by bootstrapping a pool on Duality. Then trades from within and from in and out of Cosmos, coming in and out from like Ethereum or USDC into Cosmos, all that transaction volume and revenue can be directly captured by the Cosmos Hub's community pool, and then also the validators in terms of the transactions and everything that's earned in the periphery of it. Of course, Duality taking 0% of any of this. This is all Cosmos Hub owned.
So, okay, the community pool is a large LP of like a Duality atom based pool. Is it going to be taking fees, fees?
So this is up for debate. I personally think that to compensate for the risk, it should take a small portion, like a small amount of LP fees, to compensate for the fact that hey, still some issues with impermanent loss. Like, we're still taking protocol risk here, etc. So I personally believe that the community pool should aim to profit from this position.
So, given that you're one of the earliest users of Interchain Security, meaning it's a pretty uh like a blunt force object in terms of technology right now, in that you still need to use the community pool for a like a one-time transfer, right? And then we have to it's pretty manual. And in the future, when once Interchain Security becomes a fully automated mature product, then one would guess that as a delegator yourself on the Cosmos Hub, or as an Atom staker, right, you would be able to opt in to like LP from the hub to any consumer chain with a DEX like Duality, for example, and be able to LP through those means instead of through the community pool that a user directly does not touch. And so you'd be able to have like a very dynamic composable ecosystem at that rate. But who knows? That might be Interchain Security v4, right? Like far down in the roadmap.
Yeah, that's interesting. I have to give that some more thought.
So we have a question from the audience. Soy to Studio asks, "Sounds great for Atom. How does Duality make money?"
That's a great question, and we've actually had that question a lot, and we've also had it in the community proposal. In fact, we were asked that so much that we ended up including it in the FAQ of our proposal as a point of what's in it for Duality. And the TLDR here is that we want to create as much value as possible before we find ways or avenues to take it. We believe that, I mean, it is important to have revenue, but capturing anything before we've demonstrated product market fit does not really advance the needle forward the way we're trying to. We're looking at this kind of as a more long-term perspective. We're here for the long term, and we think that if we do provide enough value and we actually materialize the vision that we're actually trying to build here, and it succeeds, we're not going to have any issues capturing value in the long term. And the analogy we make often is that this is like kind of how tech startups work, right? Tech startups don't launch a token and then try to find PMF for it. They usually, first create value and create a lot of it, and then figure out how to capture it. And we don't see why this should be any different than that.
Fair enough. That being said, what is the Duality end state that you envision?
The Duality end state that we envision. So, well, first of all, we started off by really trying to build the world's best DEX. I mean, I know that sounds a little bit silly, but like it's gotten us still here. Like actually thinking about what is the current state of decentralized exchanges, what are the issues, how can we fix them? That's honestly what the first reasons we came into Cosmos, because we couldn't fix anything on Ethereum. We were just way too constrained. So we will continue to.
What were those constraints?
We didn't have control over transaction ordering, over block times, over fee markets. All that is extremely important to actually bringing something like this to life that actually makes sense. Because that is what opens the gateway into MEV and harnessing MEV and making sure it doesn't damage the protocol and fee markets on top of that. It's like the incentive structure on Ethereum seemed to be a little bit broken for an application of the type that we were trying to build. Also, keeping in mind that it's almost impossible to build an order book on Ethereum. In fact, we weren't actually planning to build an order book to begin with. Order book is a byproduct of what we are. We are fully an order book, but we didn't set out to build an order book. It just became usable as an order book, which is what it is now. But yeah, that's why we needed full stack control. And to date, we have multiple ideas for what the future holds. Some of them will be announced soon, and some of them will probably announce everything soon. But we do expect that the future is definitely multi-chain. We're really excited about rollups. We're really excited about a lot of things. But actually, first of all, an issue of focus is that we really do need to focus on iterating on the base product before everything. There's still a lot of things we want to do, and we're really looking forward to user feedback.
Right. One of the feedback that I heard from people who've built on Ethereum is one concern that you did not list is sovereignty. So Ethereum community and the core developers have this habit of regularly hard forking, meaning they regularly will pull the rug out from underneath their users being all of the decentralized applications that depend on them. So by doing that, they compel the dev teams to have to do like a huge hard migration over to a completely new network every single time. By doing a hard fork in just willy-nilly, you break consensus for the smart contract, that like the consensus rules that the old smart contract was using, and now you have to change these rules. Like there's like some new gas fee rules that you have to abide by, right? Because now they're burning instead of whatever. And so that's bad practice. I mean, I'm not an engineer, but even I could see that would be really frustrating to deal with if you're maintaining like a full startup, like a business, on top of something that just regularly changes the rules of physics around you. And you have to learn the new rules and like figure out like if gravity is up or down or left or right now.
Yeah, totally. I mean, sovereignty is really important. And in fact, I remember a surprise hard fork that happened a couple of years ago. And everyone was kind of taken aback because there was some Web3 service providers, API providers like Alchemy and Pura. And I remember it was one of the two that didn't properly sync up after the hard fork, and it caused some pretty major issues in our application, and people lost money. So I mean, it's definitely a problem, and it is what it is. But there's other benefits to Ethereum, but in order to build like actual serious stack deep, like fully tailored applications, then all of those, including sovereignty, are exceptionally important. In fact, it's impossible to really build without.
Yeah, and by the way, you said that the order book was a byproduct of you building on Cosmos, whereas the AMM is a byproduct of building on Ethereum, given its limitations.
Yeah, so
So
I mean,
interesting that you were going
really,
back.
I mean, it's like there's a really simple way to put this is that on Ethereum we had a very similar design, just a sum of constant sum pools. But on Cosmos, we have a sum of constant sum pools, but we also have a very cheap way to do like O of one limit orders on top of it. So now if you only do limit orders on a constant sum pool, you have an order book. It's that simple. It's just one little tiny unlock that allows it to be an order book, basically.
But your order book is constant complexity. It's constant.
Yeah, we can do O of one limit orders.
All right. Okay. Anyway, that's interesting. That's an interesting claim. I would love to see that and be able to verify that. But okay, yeah. Anyway, so this is my one last question before we wrap up. You mentioned that y- Duality would like to import the economic activity and value from the EVM ecosystem. So how is that going to be done? You need a bridge, right? What kind of bridge? Which bridge?
Uh, it depends, really. I mean, Axelar is a good one right now. They're secure. They have a lot of TVL. Their team is fantastic. They're close friends. By close friends, I mean like collaborators. We've been talking to them. We actually integrated their general message passing middleware. We're working closely with Squid, the team that is also leveraging them for cross-chain UX experiences. Really, really, really nice team. So yeah, I mean
Squid's amazing.
Oh, you like them? I really like them.
Oh my
Um,
goodness. If you use Squid, you'll think that you're in the future. You're in like the DeFi future rather. Or you'll think that you're in CeFi with like a cute
yeah,
interface.
I mean, I'm really excited, but yeah, this is the future, of course. At least in the short term, future looks like this. So um, yeah, this is
The short-term
Axelar
future
at the core of
is
it.
still orders of magnitude better than the de facto UX in the EVM ecosystem.
Well, a Cosmos ecosystem too. So we had a bit of an exercise with our team. Is we gave everyone like zero point 0.4 ETH to go buy a bad kid on Cosmos from a blank Ethereum wallet to a blank Cosmos wallet. Um, no one could do it. Someone used the two people used the wrong bridge over to Osmosis, and then had to one of
The
them had to like
wrong
spin up.
bridge?
Yeah,
What
they used
what do they use?
wormhole instead of Axelar, and then they had to spin up a node to use the pools that are hidden from the UI to swap. The other one was locked for 24 hours, bridging back, or was it Gravity? I don't remember what it
Wait, was
was,
this
but
before or after Squid?
this was like a couple months ago. Um,
I guess before. The Squid
and
would have not been more
to
than
the
3 months
people
ago.
that made it onto Osmosis and had Ether, there's no more free transactions, so they couldn't find a way to get Osmos. So I think a solution was to go to Crescent, go to Juno, claim the airdrop, swap over, and then like send a bunch of IBC transactions, and eventually go to Stargaze and buy the NFT. But it wasn't simple. It could
This
be a
must have
lot simpler.
happened. This must have happened in the unfortunate window before Squid was ready, and
It did.
uh,
That was the
wait, sorry,
unfortunate window.
no, and before, no, and after Osmosis implemented non-free gas fees.
Yes, this is
That was a
after
small
Osmosis
window. There's like a
implemented.
small, like few weeks of overlap. That was very unfortunate because I was able to make those transactions with relative ease, but operating outside of that window of time that you're talking about.
Oh, the biggest barrier here is that not having gas for the native chain that you're landing on and needing to find it, and not being able to buy it on Cosmos because you need native gas on the individual chain that you're going to buy the gas token that you need gas for the first chain that you landed on, and it was just
Were
kind of a vicious loop.
Was the rule that they could not inject new capital through a fiat on ramp on
No fiat,
Osmosis?
no
No
full
fiat.
on,
Okay.
no DeFi only,
All right.
no centralized anything.
Okay. Fair enough.
They had to be bailed out. A lot of them had to be bailed out at the end. I had to send them some Osmo or
Hmm.
some Crescent or whatever. But
Yeah.
um, it wasn't easy. Which is I mean this again it brings into the forefront of the need for solutions like this, and something like what Squid is working on, and incredibly important, very useful, very good, and a lot more to improve. And we're really excited to work together.
Great. All right. And with that, any last comments you would like to add before we wrap up? Or
No,
where can
thank
people
you.
find you? Where can people find
Oh,
Duality and follow
yeah.
up?
So two things actually. One is our validator open group. If you're a validator, if you're interested in ICS and you have ideas of how to improve the model, we have a validator open group on Telegram. You can find the link in our proposal that's currently still live. Feel free to take a look and provide any feedback there. And the Telegram link is in the comments. And yeah, that's about it. We really appreciate any feedback here, and we're trying to push the urgency a little bit on creating something more sustainable with tools that we have at our disposal right now to kind of fix some of the issues that are currently happening before we see a revolve. So this is important and time sensitive.
Great. And when can people reasonably expect mainnet to launch?
Reasonably expect early August.
Early August. Awesome. Very excited for your launch, and Interchain FM is excited to validate for you as a consumer chain. And with that, I want to congratulate all of you people listening right now, and to the people who are listening to us later on in our pre-recorded podcast. I want to congratulate you for being a listener throughout this bear market, because this is when the building happens. All right, and I'll see you in the next one. Bye.